Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, what I like to do is buy my put or call, depending upon what I'm looking for the market to do. Buy that put or call. Now, for me, we're trading below the 200-period moving average. When this thing consolidated, and because it did below that 200 period, in my analysis, I figured the market was going to break down. If we were above the 200-period simple moving average, which is this blue line you see swooping down over price, I would very probably likely have looked for a call. I would have bought a call versus buying a put. I don't write premium. So what we're going to talk about here is pure speculation. I don't hedge. I'm looking to basically take advantage of the kind of position I might take with the spot, but instead of the spot, in lieu of that, I'm going to use an option. So it's a very different strategy, I think, than most that you typically run across where people are hedging or things of that nature. I'm literally I consider myself fairly active in this type of approach where I look for those quiet consolidation times and momentum trade using options. Because as soon as that option is going to experience what happens when that spring uncoils, as you can see what happened here just 3 trading sessions ago, as we broke down through 3,500 from that consolidation here. When that happens, the volatility goes up. When the volatility goes up, so does the value of your option. Now, let me backtrack. If anyone's joined me in these talks with the ISE before, there's 3 elements that I'm always measuring and trying to understand through price action. Okay, one is that volatility. That's the first one. Volatility is really what the benefit of options are, because there's no other vehicle that's going to let you take advantage of the volatility of the market. Sure, I can get the value pip for pip as this thing breaks down, that intrinsic value. But what about that volatility? I'm going to capitalize on the intrinsic value. And as long as I've got some time left on my option before it expires, I'm not going to have a lot of time decay eating away at the value. I remember Steve mentioning earlier, and he's got great advice, gang. I hope you really listen in when Steve does mention some of these really tactics and good strategies. If you are constantly buying options at very little time, one of the things that I believe is give yourself the time so time decay doesn't eat away at your value. I don't want to take, really what it is a trade-off. I don't want to take an in-the-money position at basically at the cost of going into a really close expiration. Because you know what happens inevitably with options? People know that they've got X to spend. They look at their account, they look at their position and say, you know what, I want to spend X dollars for my option. And we're going to talk a little bit about psychology here, not only of the market, but of what happens when you start shopping for options. A lot of people know they want to spend X, and then they start looking at the strike prices, and they start looking at the expiration dates, and they realize, well, here's the trade-off. I can either pay for time or I can pay for location. My assessment is if I have to have a trade-off, I'd rather have time on my side. I don't mind having an out-of-the-money option if that means that I'm able to have more time to let the price get to where I want. Okay, so now let's take a look at the EUI. That same block of cluster area that I was looking at before, you can see that represented here. Now the relationship is inverse. This is the US dollar euro EUI symbol. You're looking at the same type of price action, but just inverse now. Okay, so I know a lot of traders have a difficult time jumping, but when we looked at that overlay, you saw that there was a terrific correlation, but it was an inverse correlation. And we'll do this same thing with a few more pairs. So again, gang, I know I'm going through a lot of information. I am very excited about options. I'm very excited about trading in general, so I know I have a tendency to speak very fast. But if you want me to repeat something or you have a question, please, by all means, type it in. I think us traders, in a general sense, were just amped full of Red Bull or coffee or whatever the caffeine is of our choice. And, when you get us on some caffeine and a topic that we love, all heck breaks loose. So if you do have a question, by all means, please don't hesitate to type it in. Quick question I see here is from, let's see. Oh, there it is. I apologize if I'm mispronouncing your name, but Firoz, what bands am I using, please? Okay, sure. What I call this is my wave. I do not have any proprietary tools. If there's any study on my chart, I will tell you exactly what it is. I don't believe in proprietary tools. I call these grab candles, green, red, and blue, and the lines that are going across my chart are what I call the wave. You might be used to seeing them in a coral or magenta color. I've just kind of switched the colors. What these are the 34 period. Okay, I'm going to even type this into the chat window here. The 34 period, and 34, by the way, is a Fibonacci number. It's an exponential moving average. So you have the 34 period EMA. You have three of them. One is going to be on the high, one is going to be on the low, and one is going to be on the close. And that's why you see three lines going across my screen. So again, it's a 34 period EMA, three of them, one on the high, one on the low, one on the close. Okay? Now, do you see that on my chart right now? I hopefully you all do. See that on my e-signal chart right now? So when we're taking a look at this chart with these three lines, again, they're just basic moving averages. You should be able to set this up on any decent charting or charting application. Now, one of the things we talked about briefly before was understanding when the market was moving sideways or when the market is moving in a more volatile manner. My ideal time for option shopping typically is when the market cycle is moving sideways. Now, I don't mind, and this might be a little too aggressive for some of you, but I don't mind zooming into, say, a 240-minute chart, which is still a pretty long-term but intraday chart. But I don't mind zooming into a 240-minute chart or going into a 180-minute chart or a 60-minute chart and looking at market cycles and opportunities to shop for my options. I'm looking for some sideways consolidation. Price will give me the first indication of that. Okay, the three lines of what I call the wave will give me the second indication of that. So one of the biggest mistakes I see traders make habitually in their trading, not necessarily limited to option trading, but in their trading in general, is that they don't stop to ask themselves, is this market trending or non-trending? Because for me, I want to buy my puts or calls in a non-trending market, thus eliminating my paying up for the volatility. Okay? And then when the market begins to trend, taking on more of an angle on those three lines, that's when I know that I'm likely to be seeing some upside, some profitable upside on my position. Okay? So this example that I'm going through with the euro was one that was relatively aggressive because I really didn't get the sideways market cycle, but it was really clear to see over the course of, let's count it here, 1, 2, 3, 4, 5, 6, 7, 8, gosh, almost 2 trading weeks, 5 trading days per week, so, call it 8, 9 sessions there, trading sessions, where prices began to consolidate in a pretty tight range, hovering just around that 3,500 psychological level. I mean, this is a lot of sessions on this daily chart, again, all clustered up. When the range is just this tight, okay, you see how tight that range was compared to what the euro-US dollar is capable of. When I see a range this tight, I know I'm going to pay up a little bit because we have just come off the tail end of a very volatile move. So I know I'm going to pay up a little bit for volatility, but buying a call option or a put option on this day here, this day where we just screamed upward higher, okay, buying a call or a put on that day, the volatility is going to be crazy that day. I'm not going to necessarily look to try to buy an option on that day. I'm going to wait for the market to quiet down, and then I'm going to do my analysis the same way I would for spot.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.